Hello, my name is Dawit Kebede, Senior Economist at America's Credit Unions, and welcome to the Economic Update. I'm here to walk you through our updated economic and credit union forecast. The central story of the economy is largely the same as last quarter, with two exceptions: inflation and the Federal Reserve's next move. A jump in energy prices during the second quarter pushed inflation higher than we had expected. And with growth holding up and unemployment low, the Fed is focused on its price stability mandate. So for the first time this year, we are anticipating a rate hike. Looking at broader economic performance, we expect growth to stay near 2% through 2027. AI investment remains the biggest tailwind, with the largest tech firms planning another year of heavy spending, and consumers are still spending despite high prices. On the other hand, elevated interest rates, high inflation expectations, and a shrinking labor force continue to be a drag on the economy. That last point matters most. With retirements rising and immigration falling, the economy's potential growth rate has likely slipped below 2%. A 2% reading today actually signals a healthier economy than the same number would have a few years ago. There is some encouraging news on inflation with the latest report. Headline CPI is to 3.5% in June, down from a peak of 4.2%, and core inflation looks to have turned the corner. After the US-Iran Memorandum of Understanding, more tankers moved through the Strait of Hormuz, supply improved, and gas prices came down. If that flow holds steady, we expect headline inflation around 3.5% by the end of 2026 and 2.8% by the end of 2027. We see unemployment holding at 4.2% through 2027. Although reported job gains in recent months have ticked up compared to the beginning of the year, these gains are mostly driven by lower quits and layoffs rather than strong hiring. Normally, weak hiring would push the unemployment rate up. The labor force participation is declining, which means fewer new jobs are needed to keep the unemployment rate stable. Given firm economic growth, low unemployment, and above target inflation, the Federal Reserve's task is clear. As a result, we expect one rate hike this year, most likely late in the year, lifting the effective rate to about 3.8% and holding it there through 2027. Fed Chair Kevin Warsh has mentioned inflation as his top concern, and lower oil prices give the Fed room to wait, but not a reason to cut. On the long end, we see the 10-year Treasury staying in its recent range, ending near 4.4% in 2026 and 4.3% in 2027. Now, let's turn to credit unions. We've trimmed our savings growth forecast to 5.5% this year and 6% next year, both below the long-run average. Households' ability to save is limited with high prices. Right now, the personal savings rate is 3%, which is exceptionally low. Higher interest rates also keep money markets competitive. The risks here are mostly to the upside, though, especially if equity markets cool and funds return to insured deposits. We've raised loan growth from the last forecast slightly to 5% in 2026 and 5.5% in 2027, driven by stronger first quarter results. However, high rates continue to soften demand for mortgage and auto loans, which account for the majority of credit unions' loan portfolios. We expect improvement in asset quality. We have seen delinquency ratio decline from a shade above 1% at the end of last year to 0.84% in the first quarter of 2026. We project this to climb to 0.95% by the end of this year and 0.9% by the end of next year, supported by a stable labor market and lower fuel costs. And earnings look solid. We project return on average assets to be higher than last year's and hold steady through 2027. Stronger earnings should lift the net worth ratio north of 11.5% through 2027, giving the industry ample capacity to absorb shocks. With all this said, there is one major risk to this outlook. Our forecast assumes de-escalation in the Middle East and an improvement in energy supply. That progress now looks fragile. A sustained blockade of the Strait of Hormuz would disrupt oil supplies, push up gas prices, and change our outlook for inflation and growth. Thanks for watching, and we will see you next month.